Hello everybody, my name's Tim Hughes. I'm the Director of Communications at Spirit Invest. Today it's my great pleasure to speak to Marc Wiese, the Managing Director of Warwick Wealth. Marc, today you're going to talk to us about discretionary fund managers and discretionary fund management and wrap funds. Take us through what we need to know about DFMs and wrap funds, please.
Well, thanks, Tim, and thanks for joining. I think the concept of a DFM or discretionary fund manager has come a long way. It was probably introduced close to a decade ago, and I think the bulk of the larger flows on a platform perspective are going into wrap funds managed by DFMs. Now, it might be worth just explaining a little bit what is a DFM and what is a wrap fund, because I think it's quite a complicated concept for a lot of people to understand. But effectively, a DFM is a discretionary fund manager. It's a professional entity that focuses on researching and investigating underlying funds in order to build portfolios that suit clients' needs. Now, in terms of those portfolios, they're called wrap funds. And the wrap funds are effectively a single managed investment product with several underlying unit trusts or funds in order to build a specific client profile and risk profile to achieve the goals that the client's looking for.
So Marc, can you outline for us then what are the benefits both to financial advisors and to clients in particular, please?
Well, I think it's quite a long list, but to nail it down to the main advantages, I'd started looking at the advantages for a financial advisor. I think financial advisors have a limited time, often limited skill sets in terms of what they've been trained and focused on providing clients for the past several decades. And generally, financial advisors focus on providing clients with expert estate planning, looking at their tax position, looking at their risk profile. But I think the reality is the number of trust funds out there has grown dramatically over the past probably 1.5 decades. I remember joining the industry about 15 odd years ago, and there being close to 100 or 200 different unit trusts out there. I think we up in more than 1,500 different funds now. Purely from an equity space, I think there are close on 200 different equity funds out there. And most of those asset managers are probably looking at the top 100 equities on the JSE. So it's become increasingly difficult for financial advisors to analyze these unit trusts, to see how to add them together, look at correlations, and build a basket of unit trust funds for clients that really suit their needs. Over and above that, I think the markets start moving a lot quicker, and it's been a lot more volatile over the past decade than before. And the ability of a DFM or a professional entity researching these funds underneath and building something that suits your client's needs, I think has really become a cornerstone of investing in the modern world. I think the advantages are probably a lot more vast than that, but there are other elements like the requirement of financial advisors to due diligence and research the funds that they invest in. I think that's quite a cumbersome process and often requires a whole different skill set, again, to what advisors have been doing for the past decade or so. So partnering with the DFM will come in and research the underlying funds, ensure the correlations between the different funds make sense. There's no point in investing all the funds that have the same investment style. And then I think more practical elements from a client point of view, the ability to switch between different funds and asset allocations with a DFM pressing a button through whichever platform the clients are invested is simply a lot more efficient than a financial advisor having the need to sign hundreds of switch forms and submit these through to the platforms. Lastly, which I think is also quite a big one, is from a tax point of view. Now, a wrap fund is not a traditional unit trust fund. It is a combination of different unit trust funds bundled together in a single client investment. And when one switches from one fund to the next fund underneath, underlying in the wrap fund, it does incur capital gains tax, and certainly could be seen as a negative. From my point of view, I think that for a lot of clients who aren't utilizing their annual tax allowances in terms of capital gains tax, the ability to switch and create some tax events throughout the year, instead of building a capital gain going into decades in the future, that really becomes a big problem for your estate in the future, is probably more of an advantage. So in a nutshell, the clients benefit from wrap funds. I think that advisors benefit, and it's certainly professionalized the industry to some extent.
Thanks, Marc. There's a lot there, but then in summary, would you recommend wrap funds and a DFM?
I think clients' goals and needs are obviously different. Specific clients who are looking for more of a single fund manager approach or share portfolio, something that's bit more bespoke. It might not be the right option for them. But I think for vast majority of clients out there, making use of a DFM, and for financial advisors to use a DFM and invest into customized and well-researched wrap funds certainly has a lot more advantages than disadvantages, both for the clients and for the financial advisor. If you are a financial advisor out there considering using a DFM, I know there are already quality DFMs in South Africa, and it's been quite encouraging to see how the industry has grown. But please speak to us. We manage our own DFM structure, and in the partnership structure we offer through our wealth advisor partnership certainly holds a lot more advantages than just the DFM.
Thanks, Marc. That's a great wrap and useful insight, both to financial advisors and, of course, clients. Thanks very much. Look forward to speaking to you again soon.
Thanks, Tim, and thanks for listening. Have a great day.